We're going to continue in this video talking about the adjustment process, the accrual process. One of the things that we have to recognize expense for is the useful or the uses of our plant and equipment. Buildings, the equipment itself, motor vehicles. These are long-lived assets that are going to help us produce revenue every year. And depreciation is the process of allocating that cost. Remember, these are historical costs. We're going to allocate that cost across the life of the asset over its useful life. So depreciation itself really doesn't attempt to report actual changes in value. It takes the cost. Let's say we paid $50,000 for a truck, and we're going to write that off over 10 years. We paid $50,000 in cash today, but this year we're going to have to recognize 10,000 of that, right? 1/5 over 5 years, right? 1/5 of it we'll have to recognize. And then the next year, another fifth. So at the end of 5 years, we have distributed that cost over the 5 years of the asset's life. So with depreciation, again, they're assuming here it's $480 a year or $40 a month. Where do we put that? Well, it's a special kind of an account. We really don't write down the asset. Remember, we keep this as historical cost, but we have another line item here. This line item is called accumulated depreciation. So this is where we're going to tally all of our depreciation expenses for the equipment. So it's -40, and of course that's an expense, so it's negative over here. And I don't want to keep repeating myself too many times. I know it gets a little annoying, but that means what? Since it's on both sides, either side of the equal sign, they have to have the exact same sign for them. Again, keeping everything in balance. So again, this asset, if you really look at it, we paid $5,000 and we've just expensed $40. What this calculates, $4,960, when you add those together, it creates what we call the book value. Again, this is the difference between any cost and the total of all of its accumulated depreciation. What about unearned revenues, right? We get the cash up front and then the revenue is recorded later, right? So these unearned revenues, what causes those? Things like rent or airline tickets, right? You buy your ticket today, but they don't earn that money until you actually take the flight. Magazine subscriptions, some customer deposits, all these things are examples. There's a difference between when the cash is received and when the actual revenue is earned. So let's kind of move on and talk a little bit more about these adjustments for what we're referring to as accruals now. So what's an accrual? Again, there's just a difference in timing. So prior to making an adjustment, there's the revenue account or the expense account is understated. Something has happened and we haven't really recorded it yet. A great example of this is your paycheck. So let's say the end of the month ends on Thursday. You get paid every Friday. Well, the month ended on Thursday, so on Thursday at the end of the month, we have to show your pay for the first 4 days of this week, right? But you're not going to get paid. So we show the expense and then we show that we owe you that money. Now, what happens when the next day happens? So we adjust it on Thursday, and then we have to unwind it on the very next day and take it back to show that the cash and supplies are all going to be matched. Okay, so how does this again happen? We received $1,200 for some trips, services for trips, right? The company determines that it's earned $400 of that $1,200 we earned in October. So again, where does that go, right? Here's our unowned services. We've already recorded the $1,200. At the end of the month, we have to show that we have used, right? We have earned some of this unearned money. It's revenue here, and over here, then it is a negative number. And remember what? Here's the equal sign. Since they're on the same side, they have to have opposite signs so we keep everything balanced. Accrued revenues. We write down the revenue and then we're going to get the cash later. This could be rent or interest, right? Some kind of services that we performed. So again, we provided some services for $200, but were not billed to clients yet, right? We did the work, but we haven't billed them yet. So we're going to have to create an accounts receivable to show that a customer owes us some money. And over here, we're going to show that as a revenue. Now, why do we show it as a revenue? Because we actually earned this money. We earned it. How we get paid or when we get paid is a separate question, right? That's what this adjustment, again, is all about. So again, we received the $200 for services. This is just an example of that. When they actually pay us, right, we get the cash and we write off the accounts receivable that they no longer owe us this $200. Accrued expenses. The expense is recorded, but we haven't made payment yet. Interest, taxes, utilities, salaries. These all fall under this category where there's this difference between when something happens and when the cash is actually paid. So here we signed a 3-month note payable for $5,000. It requires us to pay interest at 12%. 12% of 5,000 is $50. So how are we going to write this off this month, right? So we have interest payable. We owe this interest. Now we're not going to pay it yet. We're saying we owe it. Over here, we show that it is an expense for this month. Again, what? They're on the same side of the equal sign, right? Or they're over here. So we have we create this liability and we have this retained earnings over here shown as an expense. Salaries, this is kind of what I was talking about before. We have a 5-day work week, $400 per day. On October 31st, right, we've worked for 3 days. That's $1,200. We need to show that in October. So what do? We know that we owe somebody $1,200, and here's the negative $1,200 that we show on the expenses. And again, what? They have to be opposite signs to keep everything equal and balanced because they're on the same side as the equal sign. So now what happens? At the end of the period, again, we've made all of these adjustments. Now we can complete our financial statements once we have adjusted them. And again, we don't really talk about it in this class, but on the first day of the next month, all of these things that we have set up that are payables, we can unwind them again to show where we're starting in the next month of the next period. So again, we see the income statement connects to net income, right? Net income connects to the retained earnings statement. We adjust that for dividends. Then retained earnings is part of the equity section of the balance sheet. So now we can create the balance sheet, the income statement, and the retained earnings at the end of the accounting period. So I hope that wasn't too confusing. As you go through and think about the events that can happen, now you just have to think, well, what accounts, what line items, what things are impacted? And then think about where they're at in this accounting equation. remembering what? That if they're on opposite sides of the equal sign, they should have the same sign. If they're on the same side, they should have equal signs. Again, look forward to talking to you next time. Bye-bye.